Hello, everyone. Welcome and thank you so much for joining us today for our webinar, A True Breakthrough in Bank Account Validation, How Predictive Data and Real-Time Insights Are Reducing ACH Returns and Minimizing Risk. We're really excited to have everybody here. Today, we're thrilled to have Amy Morris, who's the Senior Director of ACH Network Rules at Nacha, as well as James Cook, the Vice President of Product Management at Accelitas, leading today's session. Between the two of them, they bring a ton of expertise in ACH operations, compliance, and the innovative tools that are making a difference for businesses like yours. With that, I'd like to let everyone know that this is going to be as interactive as possible. So if you have any questions, feel free to drop them in the chat at any time. We'll save some time at the end for a Q&A session, but don't hesitate to reach out after the webinar if you have any additional questions. We're always happy to connect. So let's get started. I'll hand it over to James and Amy to kick things off. James, take it away.
Thanks, Sabrina, and hello, everybody. And yes, on behalf of us here at Accelitas and our friends at Nacha, I'd like to thank everybody for your time today as we dive into bank account validation, as Sabrina had mentioned, and a recent breakthrough that we have made here at Accelitas that has been pretty exciting in the marketplace. So our agenda today, we'll visit some details on, or revisit for some of us, some details on the Nacha ACH return process, and then discuss some key challenges that many of our customers and folks we're talking to in the market are facing around bank account validation, and then finally kind of address this breakthrough solution that hopefully will help you solve and address some of these challenges. So again, James Cook here. I've headed up the product management efforts here at Accelitas for the past 5 years and have been working pretty extensively with our bank account validation solution as well as our other solutions here in the organization. And as Sabrina had mentioned, with us today from Nacha to introduce herself is Amy Morris.
Thank you so much. I'm so glad to be here with you all today. My name is Amy Morris. I am a senior director at Nacha. I work with the rules and the risk department. And so as James mentioned, some of what we're going to go over today, it might be a little bit remedial, but I'm always a geek for the rules. So I'm really excited to be here to talk about returns, what they are, and how we can try to avoid them.
And for those of you who may not be familiar with Accelitas, real quickly, we're a data analytics company headquartered in the San Francisco Bay Area. We, throughout our history, leverage alternative data sources to help our consumer lending customers with their lead screening and loan underwriting activities. But we're also a proud Nacha preferred partner, and we help various markets, various organizations with their bank account validation needs. And so that's obviously the focus of our discussion today.
Awesome. So I'm going to go ahead and get started by laying some groundwork here and talking about what ACH returns are, because sometimes folks get a little bit confused about rejects, returns, reversals. So just want to clarify a little bit here. There are such a thing as returned transactions in the ACH network. So under the Nacha operating rules, we define them as a credit or debit entry that is initiated by the RDFI, which is the receiving financial institution. Can sometimes be by the ACH operator, but we're really here talking today about those that come from the RDFI. And it returns a previously originated credit or debit entry. And so basically, there are times when a transaction is going to be received at the receiving financial institution, and they're not going to be able to post it. And when that happens, they must return the transaction. So there are different buckets that we could kind of put the common reasons for why one might get an ACH return. Top bucket there being insufficient funds. So if you are originating a debit or a pull of funds out of your customer, the receiver's account, sometimes it happens that the funds are not available to pay that transaction when it is received by the RDFI. So as a result, they're going to return that transaction back to the sender. For debits and credits, there can be a situation where the account number that's been provided to the sender of the transaction is invalid. Somebody might have made a mistake when they were typing something in or reading off numbers, and as a result, it doesn't match any of the accounts that are on file at the receiving financial institution. So again, they can't post it. They're going to return that transaction back to the sender. And so those types of returns we have in what we call our administrative returns bucket. And that's really what we're going to focus on here today. And sort of the third bucket that we have are when the transaction actually has posted to an account at the receiving financial institution, but for one reason or another, the account holder has requested the return of that transaction. So one thing that's important to understand with the ACH network is that returns are both the return of funds. So if we're talking about a credit transaction, in a return, the funds are going to be returned back to the sender. If we're talking about a debit transaction, the funds are going to either be returned to the account holder if the transaction did post, or they just simply will be returned back to that financial institution when that return is processed. But in addition to moving funds, the returns in the ACH network also include a return code reason, which is a message back to the sender why this transaction is being returned back to them. And this reason is very important. It's very important for us to analyze, because it's going to dictate how we're going to handle that exception going forward. If it's an SF, we're probably going to want to resubmit that for payment again. If it is an unauthorized transaction, then we're going to do some digging into what may have happened there. How can we prevent it from happening again? Perhaps contacting the customer. Did you really mean to do this? Did you not recognize our transaction, et cetera? And the administrative type of returns, again, is going to require us to get a better account number to put forward a new transaction authorized under the correct account number. So all of these different types of situations, as you can imagine, they require a lot of manual handling. And so as we're going to continue to talk about through this webinar, we want to try to minimize exceptions, both for the receiving financial institution. They have to spend some costs there to deal with returns, but also in the sending side, we want to make sure that our transactions are going through efficiently, and that we're not having to deal with collections situations, that we don't have customer service issues that we're dealing with, products that are already gone that we need to collect on, etc. And so again, very important for us to look at the reason why we're getting back a return. So because returns have such an impact on both the sending party and as well as the receiving party, it really can be an ACH network quality issue. And so we want to make sure, again, that we are keeping our return rates as low as possible. And so on the debit side, within the actual ACH rules, we have thresholds for each of those different buckets. We have an administrative return threshold. We also have an unauthorized return threshold, and then we have an overall return threshold, which takes into account those NSF transactions, et cetera, because we want to make sure that all parties that are originating transactions and are a part of originating transactions have good, clean practices in place. Again, better quality transactions make for a better quality experience for all participants. So as a result of the network having these thresholds, that sort of filters down into monitoring. So a financial institution, an ODFI, we call it, that's the institution that puts the transaction into the network. They're going to be monitoring the return rates for all of their customers. If there's a third-party sender that's involved, they're also going to be monitoring all of their return rates for their customers. And originators should be monitoring their rates as well, again, to make sure that you've got good, clean practices in place, as well as staying out of any gray areas, because not only do the rules have thresholds, but as a result, those ODFIs and third-party senders may have their own thresholds, again, to ensure that they're staying out of any concerns. So when we move on, we can look at sort of the flow of how a return transaction will happen. When we look at the outer rings or circles, not a true circle, but the outer part of this diagram, we are looking at how a message is going to flow. So the black arrows there are the forward transaction. It's going to come from the originator, what we call the originator, the party that's creating the transaction. Now we've kept this simple, so I didn't put a third party sender in there, but there might be one in between them and the ODFI. That message is going to continue to flow from that ODFI, the financial institution that puts it into the network, to what we call the ACH operator that parses out ACH transactions and sends them to the correct receiving depository financial institution, or RDFI. So that black arrow is going to continue on over to the RDFI. Now we've got then a happy posting path. If all is good, then that transaction is going to be posted to the receiver's account at the RDFI. Now, in the center of this diagram, that is the flow of funds. So what is going to happen in a debit example here that we're looking at, on the forward side, again, the black arrows, the ACH operator is going to debit the RDFI's account with the operator, and the RDFI is going to offset that by debiting the receiver's account, and the funds are going to flow into the ODFI's account and then onward into the originator's account. Now, let's say that something has happened and we've got a return of a transaction now. So now we want to look at the red arrows. So if it was a case of the transaction posting and the receiver requested the return, then we've got the red dotted arrow. But in the case of an administrative return, the RDFI was never able to post that transaction. And so they're going to send that message with the return code reason back through the same way that it came. And then when we look at the funds, again, the funds are going to be removed from the originator and ODFI's account and given back to the RDFI. And then, if necessary, back into the receiver's account if it was a receiver requested return. Now, very little changes when we talk about an example of a returned credit. In fact, the outer ring here, it doesn't change at all. The ACH network is unique in that we process both debits and credits, and the participants do not change, regardless of whether the transaction is a push of funds, which are credits, or a pull of funds, which are debits. What changes in that type of an instance is the flow of the funds, but otherwise everything stays the same, regardless of whether it's a debit or a credit. So on to the next, then we are going to talk about the return time frame. So you're probably asking yourself, okay, well, how do I know when I'm going to get a return? With the exception of consumer improper or unauthorized transactions, all other returns are returned back to the ODFI under our standard return time frame. So it's a bit of a mouthful. It has to be received by the RDFI's ACH operator by its deposit deadline for the return to be made available to the ODFI no later than the opening of business on the second banking day following the settlement date of the original entry. So basically, in layman's terms, this is 2 days. Really, it's about 24 hours for the RDFI to make their determination. And then by the time that information is given to the ODFI and it's passed back down the chain, whether that's through a third party sender or not to the originator, you would know within about 2 banking days whether or not you are going to get a return of a transaction. This can be sped up some if RDFIs are taking advantage of the multiple same-day windows that we have throughout the day. But when you're trying to make a determination, okay, when I think I'm out of this window, like I said, really looking at the second banking day. Then when we talk about the extended return time frame, those are those consumer improper or unauthorized transactions, and that extended return time frame goes to the 60th calendar day. We have different times there because we have other regulations such as Regulation E that governs electronic transactions to consumers' accounts that we have to contend with. But when we go on and we look further, this is going to explain some of the flow of what's allowed back and forth on our next slide. we are showing how a forward item will go forward to a transaction, to an RDFI, and then it's gonna, well, if we're able to advance the slides, there we go. Okay, so we've got the forward transaction going to the RDFI, and then the RDFI's got that 2 banking day time frame in which they can return it. Now, if something is wrong with that return, let's say that it was untimely, it was done, 10 days after the original transaction, there is recourse available to the ODFI or the originator. They've got 5 banking days to do what we call dishonor a return. So they would dishonor that return with the code that says this is untimely. And so it's going to be kicked back to the RDFI. At that point in time, it's gonna rest with the RDFI. But let's say that it was for some other reason. Let's say that it had incorrect information in that transaction or in that return transaction. So we've got the 5 days for the sending party to be able to dishonor that return, give it back to the RDFI, and then they have 2 more days to be able to either contest and say, yes, it has the correct information, or to be able to correct that return and send it back to the ODFI. So one of the key takeaways I want you to have from this slide here is that under the ACH rules, the ODFI holds the warranties on that original transaction. They warrant that it is properly authorized and that it contains all of the correct information. And so that's why you see the end of this chain through the ACH network process always is going to end with the ODFI, because ultimately they are the party that is providing the warranties and holding the liability against all of the other parties within the network. Okay, so moving on, just a little bit of extra information for you here. This comes directly from the Nacha operating rules. Specifically, Appendix 4 has the entire table of all return reason codes. But just to give you sort of a flavor, here we've got, our NSF or uncollected reasons, again, under the standard return time frame. There could also be a stop payment on a transaction. Perhaps the account is frozen. We also have an R17 return reason code, again, that's available under the standard return time frame that has a dual purpose, either for field errors, something was wrong with the formatting of the transaction, or it can also mean questionable when we put questionable in the addenda record of the return, which means, hey, this is something that the sender needs to take a closer look at. Something is potentially going on with this, and we need to make a determination on that transaction and potentially make actions to prevent future questionable transactions from going through the system. And then we also have an unauthorized reason for non-consumer transactions that is also under the standard return time frame. We've got those R10s and R11s. Again, this is not in a fully exhaustive list, but most commonly used codes. Those are those that are under the extended return time frame. But we're really focusing in on that administrative bucket today, which are the R02s, which can mean account closed, or 3 and 4, which means we've got the account number wrong. And so again, remember, those are under the return, the standard return time frame. All right, now finally on my last slide here, I just wanted to give you a little bit of information on sort of what's going on with the administrative return rate trends. Now, this graph here is not scientific. You will notice that the first several data points there are annual, and the last few are the 3 quarters that we've been through so far of this year. So we're seeing a bit more of a downward trend there than we would if, we had the full year of just 2024 data. But I just wanted to also mention that this is extremely blown up, because when we're talking about changes in the actual return rate for administrative returns, we're talking about hundredths of basis points. So this is not a rate that, significantly varies, but we have seen some things over the years. So when we look around the time of the pandemic, we started having more and more administrative returns, and there was a couple of reasons for that. One, during the pandemic, there were some folks who unfortunately were attempting to commit fraud. They had nothing better to do than watch social media videos of folks that were trying to teach them very bad practices where they thought they were going to be able to get away with buying stuff and not paying for it. That didn't work, but folks tried. We also, during the pandemic era, had some times where there were first time recipients of benefit payments. And so with that, there could have been some mistakes when they were giving those account numbers over to those parties. So we saw a little bit of a spike. But then some things started happening. The first one being Nacha's what we call our web debit rule, which was a supplement to our existing web debit rules that required account validation. For the first time, one was going to be debiting a consumer account based on an authorization provided online. We also had some other rules go into play at the end of 22, the beginning of 23 around micro entries. Micro entries are very small dollar transactions that are sent and verified by the receiver. Now, micro entries and the rules around them are not going to necessarily create a decline in our administrative return rates. But what was happening during this time period was that account validation was really being talked about and discussed. As a result of the web debit rule and further conversation around different types of account validation, it really raised the awareness of account validation for originators. And as such, we are starting to see small declines in that administrative return rate because folks are taking advantage of this either through web debits or also expanding this beyond just their web debits to all types of transactions. So the administrative return rate threshold is set at 3%, just so everybody knows. But and while this is much higher than what an average originator should be experiencing, the monitoring that I mentioned at the beginning is very, very important because we do have some parties, if they're not paying attention, they don't have good practices, good authorization hygiene in place, they can creep up above this threshold. And so again, very important, that we really are practicing, very clear and concise authorization policies and practices, making sure that we're doing things to be sure that we've got a good account number. And so I want to remind everybody that we're going to have some more Q&A at the end of the session. But with that, I want to turn it over to James to talk some more about really why we want to avoid having these types of exceptions with our payments.
Yeah, thanks, Amy. Thanks for the insights that you provided there and some of the basics. I've seen some of this stuff before. But certainly don't have it committed to memory. So it's good to get the context back in place again. So we wanted to dive into some of the challenges that we've been hearing from our customers and seeing in the marketplace, and that some of you may be experiencing yourselves. So we'll, discuss the several different bank account validation approaches that are available to consider. We'll also touch on, the fact that these solutions that we choose to use do have impacts both on our end users, whether it's the consumer or the folks within our own organizations who are monitoring and working with the bank account validation. So we want to take that into consideration, the whole consumer impact. And then like anything, there's going to be trade-offs of overall performance, right? And these trade-offs need to be taken into consideration. And the trade-offs can differ from organization to organization, depending upon what your use case is and what it is you're trying to accomplish. So as we've heard Amy describe and we've seen in our quarterly Nacha volume reports, right? ACH transactions just continue to rise, right? More and more ACH activity happening. And so with that, the need for bank account validation has become, ever important, right? We want to make sure we've got clean transactions, quality transactions going into the network. As mentioned, there's several different bank account validation solutions that companies can consider. We've kind of listed 6 of the more popular approaches here or often used approaches here. But unfortunately, there's no one of these that's kind of the silver bullet solution that addresses everything, right? It's a combination of these things that folks are looking to use. And what we found in talking with our customers is, some of these organizations, if they aren't really looking at these multiple approaches and trying to make sure they can optimize their approach across these solutions, they've really run into some either costly scenarios or some, friction-based type of scenarios that has really impacted their businesses. So important to be optimizing and understanding each aspect of these solutions. And of course, as Amy had mentioned, we always want to be mindful of the ACH admin return, Nacha admin returns, as well as just in general kind of staying compliant with Nacha operating rules. And Amy had mentioned the Nacha debit rule, web debit rule that we need to stay compliant with. So image over here on the right certainly tells a story. I think we're all aware of the importance of, in this online world and the user experience. We've all probably had these similar type of frustrations. We've gotten used to doing stuff online, electronically, so easily. And when you run into friction, it can be pretty frustrating. And these various statistics that are listed here on the slide kind of show, users are going to abandon your process or be very frustrated with you if they're encountering too much friction. And again, that includes, your employees who have to work with these processes as well. And then when users are choosing to use ACH payments, right, we want to ensure that both their onboarding experience and their payment experience are without friction. You could imagine Amy was talking about the ACH return flow and how, it could be a couple of days before things return, and there could be some back and forth, discussion on it. That's got to be very frustrating for a consumer if they think their payment has gone through and for whatever reason their payment hasn't gone through. And equally for the, the company that's trying to support that consumer, if things are, kind of messed up along the way and things aren't flowing very smoothly. And so really want to ensure that we've provided accurate bank account information to help avoid any of these downstream complications, for ACH payments not processing. So this next slide, a little bit of a difficult slide here. I'll take a moment to walk us through this piece. What we're showing on this chart are the trade-offs among cost, friction, and coverage for various bank account validation approaches. Vertical axis here represents friction, and you'll notice the scale down at the bottom goes from high, and to the top it goes to low. So that's a little bit reverse as to what we typically look at. And then similarly on the horizontal axis where we're representing cost, the scale on the left is high. Excuse me, the scale on the left is high and low over to the right. And then the diagonal line on the chart represents the effective coverage of some various BAV solutions, right? With the coverage increasing as we move up the line. And so part of these trade-off considerations here, it's really the nature of the riskiness of the ACH payment that you're dealing with, or potentially the consumer who you're dealing with, right? If the risk is low and I really just need to verify an accurate routing and account number, I'm probably up in the top right section of the chart. So relatively low cost, low friction, and some good coverage out there. But if there's greater risk associated with the payment, I may need a more detailed understanding of the bank account, right? And that brings me down to the bottom left part of the chart here, bringing on some more cost, some more friction, and oftentimes less coverage to be able to find the information that I'm looking for. And so what we've been hearing from our customers who kind of deal with all these different scenarios here is that, even if they need a more detailed validation approach down in the bottom left here, it's important to ensure that the routing and account number combination is accurate before they move on to any of these costly, more impactful validation steps. And so that really leads us to our true breakthrough in bank account validation here, the focus of our discussion today. What we see here, again, the 6 more popular bank account validation services that companies are typically employing. Now, no one would use all 6 of these in a workflow, as we've displayed here. But again, since there's no silver bullet type of solution, companies are going to use some combination of these ACH payment workflows, right? And through that, really need to take into consideration cost, coverage, and friction. And so what we've done here at Accelitas is we've actually developed a patented approach to validating the combination of the routing number with an account number. That's our AI Validate BD solution that we've depicted here. And what our customers are doing with this service is they're really adding it up front to whatever their ACH payment workflow is, right? And it's enabling them to achieve some higher success rates. They're able to get more transactions accurately through. They're not getting the returns. They're reducing their downstream costs. Amy had mentioned that, there's costs associated with any of these returns coming back from your ODFI and the RDFI. And then, of course, avoiding any of these annoying friction points with your consumers, folks thinking that a payment has already gone through. I set up my information and away I go, and then come to find that the payment didn't go through and I'm being contacted again and I need to go, key in or provide more accurate bank account information. And so the service, what it does is instantly scores 100% of the US bank accounts, right? And so this is essentially eliminating those R3 and R4 admin returns. And of note, it's a very simple REST API to implement, runs on our SOC 2 compliant platform, and has really been a big success for our customers. And of course, that's the most important thing, right? What are the customers saying about this service? What's the feedback that we're getting? Interestingly enough, it's very easy to get this approved through their vendor due diligence programs. I mean, you don't always think about that necessarily as a #1 thing, right? But it is an important piece. We deal with a lot of larger organizations, and so they've got a lot of vendors, and vendor due diligence is a pretty, formal, strict process that they adhere to and go through. And we found that this service is very expedient to get through the vendor due diligence programs. And then when it comes time for the operations folks to actually implement the service, again, very straightforward API service, easy for folks to implement. We work with a number of different platform providers as well. And so the service may already be running, with some of the platform third-party processors that you work with today. And being a highly predictive service, right, it's significantly reducing any admin returns that they may have been experiencing, or just in general, they're not hitting the same kind of friction points that they were seeing before, where they didn't have a very robust validation service going on in their ACH processing. And to note here, I mean, we typically perform retro testing activities in our pre-sale service with our prospects. And so this really enables folks to kind of better gauge how well is this going to perform for their specific use case. It's kind of a, try before you buy. And that has proved to be very beneficial for folks as well. So, to summarize here, our Accelitas difference, right? It's been a combination of our historical access to ACH payment transactions over the past 10 years or so, coupled with our customized predictive analytics shop. It's really enabled us to provide some successful solutions for our customers to address their pain points, including the bank account validation scenario that we discussed today. And so please go ahead and, if you haven't already, drop any questions you may have into the Q&A box. If you'd like to talk further with us here at Accelitas, Jimmy Williams wasn't able to be on our webinar today. He heads up our sales organization. His contact information is here, and he and his team would love to help. And Sabrina, I'll turn it over to you and see what we have in terms of Q&A.
Great. Thank you, James. Thank you, Amy. Appreciate the presentation here. And yeah, we have quite a handful of questions from participants. So unless I kind of field it to one of you specifically, feel free for either one of you to answer. But I'll start back at the top from one of our earlier questions. Someone had asked if they, as a fintech request, return an ACH disbursement if they know the disbursement was sent to the wrong customer. So can you request a return on that disbursement if you know that it was sent to the wrong customer?
So I'm going to start with this one, and I'm going to cover two different scenarios because I'm not exactly sure which one the question is coming from. So you can be a fintech on the sending side of a transaction. So you were involved in the origination of that transaction. If you're on the origination side and you know that the disbursement was sent to the wrong customer, you have two options. The first one is actually not a return, it is a reversal. So as part of the originating party or originating chain, you would, the actual how you're going to do this is going to be based upon your origination agreement with your ODFI. But within 5 settlement days, 5 days of the settlement of the transaction, you can actually go ahead and initiate a reversal, which is different than a return because this is initiated again by the sending side of the original forward transaction. But let's say it was a $500 credit. It went to James. It was supposed to go to Amy. And so I could create a reversal, which is a $500 debit. Everything else in the transaction looks identical, except it has the description of reversal, but it would debit that $500 and credit me back, and that would take care of it. Now, if we don't know that this has happened within the 5 days, then yes, you would get on the phone with your ODFI and have your ODFI contact the receiving financial institution and then ask for them to return the transaction. That's a different R code. It's an R06 returned per the ODFI's request. That doesn't have a time limit on it. That can be done at any point in time. Now, if the question was referring to the fintech being on the receiving side, so perhaps I have a wallet app and I know that the funds went to James, but they were supposed to go to Amy. How you can handle that is, again, going to really be determined based on the agreement that you have with the financial institution that is helping you provide those processing services. So that would really be dictated by that agreement as to whether or not they will take the request directly from you as a fintech or if it would need to come from the account holder. So hopefully that provided the full breadth of the answer there.
Great. What is the best practice for handling incoming ACH transactions that have the correct account number but an incorrect account type? The question is from Alvin.
So one thing that we did not mention during this webinar is there is an alternative to returns, which are called a notification of change. And so a notification of change is a different format. It uses C codes instead of R codes, and it does not return the funds. It instead returns a message. We have a specific C code in the ACH network that says account number is correct, but you need to change the transaction code, which is what dictates in the network the account type. And so the best thing to do would be to create a notification of change that goes back to the originator for them to make that change. Now, if you run into a situation where the notification of change has been ignored and it's causing potential, posting problems, it's, really becoming a headache, then it would be within your institution as the RDFI's determination as to whether or not you would want to continue to send notifications of change or if you would then resort to returning the transaction. But again, that could have customer or member service, impacts if you were to do that. But the notification of change is the correct procedure, and the sending side they are obligated to act on that.
Perfect. This question is for James. James, for your AI Validate BD product, which industries does it serve, and does it include credit unions?
Yeah, it's really all industries. I mean, anybody who's dealing with ACH payments and needs to validate bank accounts. So credit unions, can use this service. We have other banks and financial institutions who are using the service, as well as payment. Anybody who's doing payment activity there can use the service.
Great. Does the responsibility for maintaining and monitoring lay with the ODFI? In other words, if a return is initiated outside of the 2-day window, is it the ODFI that has to monitor and contest or dishonor it?
So the ODFI, yes, is the party that does need to actually, hit the button to contest, to dishonor the return. The determination of the responsibility of monitoring is something that you would work out within your ACH origination agreement with your ODFI. Some ODFIs have services where they are automatically monitoring and they might automatically dishonor an untimely return. But again, that's a service level thing that you would really need to work out in your ACH origination agreement to determine who's going to be the party. Obviously, there's going to be some delay in the reporting of the returns from the ODFI on back down the origination chain. And so, they're going to be the first ones to see it and really have the clearest view of whether it's untimely or not. But again, that is something that you would want to work out and set up with your ODFI or your third party sender if you use one of those.
Great. James, can you talk a little bit more about data coverage? And in one of your previous slides, there was a mention that 98% of accounts are covered through the AI Validate solution. Can you expand a little bit on that statistic and what makes Accelitas's data coverage a little bit more unique?
Yeah, so a couple of different elements in that answer there. The 98% of account coverage really points to the payments data that we've worked with over the years with our third-party data provider. And so we've seen very robust, successful payments being achieved. And that really points to the 98% of accounts covered as to what we typically see. As it relates specifically to the AI Validate PD service, that's a predictive service. And so because we've had such robust performance over the years, we've been able to develop this patented predictive model. And so we can really provide back a very accurate response, whether it's a formal bank or a credit union, based upon the information we've seen in the past. Our model is highly predictive, and can give you an answer, instantly back.
Last question, looks like it's going to Amy as well. This person has seen returns from over 365 days. Because of the long period that they're witnessing there, do they still need to honor them?
So once again, this is going to be a conversation between you and your ODFI. So I mentioned the 60-day time frame, but I also mentioned that the ODFI provides warranties. under our rules to the rest of the participants. One of those warranties being that it was properly authorized. So it is possible to have returns that are older than 60 days. We do have a limitation on our warranty in our rules. For consumers, it is up to 2 years. For non-consumers, it's 1 year. So what potentially can happen is an RDFI receives a claim of an unauthorized transaction. They go through, capturing the paperwork that they need, et cetera, et cetera. They will contact the ODFI and say, I have a potential breach of warranty claim here. Again, if it's under the two years. And so it is then the ODFI's call to determine whether or not they're going to say, go ahead and just send me the return, or if they're going to actually want to fight that breach of warranty claim in court. Most times it is much more cost effective to just accept the return than to try to litigate. But it needs to be a conversation between an originator and their ODFI, how they want ODFIs to handle these types of transactions. Are they going to just go ahead and take them back? Are they going to get charged back to the originator, et cetera? Again, is all stuff that needs to be worked out in your ACH origination agreement. But there are the rare scenarios where, yes, you could have a return, that's up to 2 years old in those types of scenarios.
Great. James, for the BAV platform that you've described, does it provide the name of a beneficiary and also the status of a bank account?
Yeah, unfortunately not. I mean, this is a common question that folks have, and it's really a big challenge that we all have in the marketplace of really being able to, kind of validate the name on the account, as well as what is the real-time status of the account. The open banking solutions kind of lend themselves to that. But again, cost, friction, some coverage issues associated with that. So unfortunately, we don't, in the industry today, have a very clean answer for that piece.
Sure. It looks like we do have just one more question. I would hate not to answer it. This person's asking if, Amy, if this counts towards Nacha continuing credits.
So I would say that that one of us, probably somebody on the Accelitas side, can get back to you on that. It could be possible, but there is a process that we would need to go to be able to issue that. So we'll follow up ourselves on that and get back to you.
I think that's
Very good.
everything. James, were you going to say something?
Yeah, no, I was just going to wrap us up here.
Please do.
On behalf of Nacha and Amy and all of us here at Accelitas, I want to thank everybody for your time and attention today. I think it's been a really good discussion, a lot of good Q&A questions here at the end. We hope everybody has a very safe and happy Thanksgiving next week with friends and family, and enjoy your time together. Thanks all.
Thank you.